Hello, everyone, and welcome to UBS Trending. I'm your host, Anthony Pastore. The Fed said they would continue to raise rates as high as necessary to tame inflation. But when is too much tightening a detriment to the economy? And with mortgage rates on the decline, is this a signal that inflation has perhaps peaked at these levels? Joining me now to discuss this is Leslie Falconio, Senior Fixed Income Strategist with the Chief Investment Office. Leslie, good to see you. Welcome back. Always great to have these types of discussions with you. Great to have you here.
Thank you.
So we're always talking about inflation, and we look at the rates market. We look at treasuries, we look at mortgage rates, and we try to figure out where the lines are drawn. Are we seeing peak inflation? But the thing is, I want to start with the Fed. So last week, the Fed said in the minutes that they committed to raising rates as high as necessary to tame inflation and bolster the economy. But they began to acknowledge that they maybe could go too far and even curb economic activity. So the question is, do you think that the Fed is tightening too much, or at least considering tightening that would be considered too much?
Well, right now, I don't think the Fed is. We don't think the Fed is tightening too much. I mean, I think to your point, price stability has been a focus for the Fed, and they've made it very well known that they are willing to focus on price stability at the cost of potentially heading into recession. But given the strength of the labor market right now, and given some of the positive numbers that we've seen recently, such as retail sales, we don't think right now they're tightening too much. Now, when the time comes that they do tighten too much, unfortunately, is normally something you see in the rearview mirror, right? As we all know, it's much easier, and we think it's easier, to get from 9%, say, CPI to 5%. It's at 5% to 2%. That's the hurdle. In order to really obtain their objective of 2%, if they really need the market to go there, right? You're going to have to see unemployment rise, and that could be something where it could really, be a headwind to the U.S. economy. But right now, we don't think it is too much. But again, to your point, Anthony, and what we're looking for in terms of, what's happening in Jackson Hole this Friday is whether or not they're going to say raise that terminal rate, whether or not that 3.8% median that they have in their forecast, which by the way is pretty much what the market is pricing in right now,
right,
moves to a 4.25%. If this continues, right, then obviously borrowing costs, the mortgage rate, the borrowing costs of corporations will become a large headwind, and then a recession can come sooner than what people are expecting.
Right. Yeah, Jackson Hole, all eyes are going to be on the Jackson Hole symposium this weekend, especially Friday when they all arrive there, and a lot of questions for the Fed that are going to be coming up at that meeting. And the Fed, their biggest debate is going to be when they start to slow down the pace of rising rates, as you said, and the pace of tightening. So that's going to be an interesting couple of months for the Fed as they progress through the rest of the year. And you mentioned mortgage rates. I saw mortgage rates have actually come down a little bit since they peaked a couple of weeks ago in June at something around 5.8%. At the last check, they were around 5.1%. We're talking about 30-year fixed. And even the 10-year Treasury, even though it's a little above 3% today, it's still down from where it was at its peak in June at around 3.8%. Do you think that these are signals that inflation has peaked? And I know that's a hard question to answer based on what we see from CPI. It did come down a little bit in the last reading, but mortgage rates are coming back. So what does that mean for inflation?
Well, listen, I mean, I think that the peak in June for 10 years was around 3.5%. And in our opinion, that's going to be the high of the year. Right, we don't right now. From what we know, we have a lot of data from now until the September FOMC, but we believe that 3.5% will probably be the peak in 10-year yield, if not lower.
Yeah.
So when you think about the mortgage rate, yes, it's come down by a little bit, but here's sort of like the puzzle with this. The majority of consumers right now, it's about 70%, have a fixed rate mortgage locked in that's much lower than what the mortgage rate is today. Right, we had interest rates back in 2020, 2021 that were very, very low, so that gave the ability for consumers to lock in a low mortgage rate, and they did. Now, for new consumers, people are buying a new home right now. For the first-time buyers, it's obviously a big headwind, this mortgage rate. Now, we've seen some headwind in terms of the housing market overall. Starts, we all know that it's starting, the house is going to be in the market longer. You don't have these sort of, hit the bid without an inspection kind of euphoria that we once saw. So with that said, what we're seeing, given the fact the mortgage rate is although it has gone down a little bit, it's still, relatively high over the past 2 years.
Right.
Historically not that high.
Historically not.
No. But there's one thing that we're seeing is people are moving to the rental market, right? So what's in CPI? CPI is the owner's equivalent rent. Now, there's a lot of nuances in terms of how that number is calculated, but the rental market is on fire, right? And so, and there's a lag. There's a lag between when, say, home price appreciation starts to decline, still positive, but just not with the same momentum, and sort of like the rental market starts to decline.
Yeah.
And we're just seeing that lag right now. So in terms of the inflation side, it's really the rental market that's keeping that inflation high, particularly in regards to CPI.
Yeah, it's interesting. You said historically they're still pretty low. I got my first mortgage in 2010, and I got a 5% on a 30-year fix, and I was doing cartwheels because the rate was so much lower. And then, of course, we all know what happened over the next 11 to 12 years.
Think about the late 80s.
The late,
it was 12%.
I was going to say 12 to 15%, right? Insane. And you can see that if you look at the chart for the 30-year, you go back to the 70s. What a roller coaster ride it's been. So historically, they're still at the low levels, but not what we've seen for the last couple of years. What about credit spreads? Have we seen the peak there?
You know, listen, credit spreads in June, the first week of July, as we know, just kind of blew out, right? It went to, if you look back to 1997, almost like that 60 to 80th percentile, meaning that it's only been, say, 40 or 20% of the time going back since 97, they had been wider than what we saw in that, end of June, first week of July period. That say it's like a 600-ish for high yield, a 175 for IG. What we saw is sort of like, which is after the Fed and after the market sort of took a step back, or in my opinion, misinterpreted the rhetoric to be a little bit dovish, we saw a very large contraction with credit spreads. I mean, I think, listen, fundamentally credit spreads, when you look at interest coverage ratios, low leverage, cash on the balance sheet, are all very strong.
Yeah.
But the amount of tightening that we've seen the past couple of weeks, I think is a bit more in the technical nature.
Is that what you mean by misinterpreted?
Yeah, I do, because the technical nature that we're seeing within the credit market right now, a lot of cash on the sideline, high yield year over year, it's like 70% below the supply number. So you've really had this large contraction. Now, do we think that you'll peak higher than that 600 over the next 3, 4, 5 months? If in fact the economy stays on track, right? And if the labor market stays as strong as it is, and we've seen a very large recovery in the equity market, we've seen financial conditions tighten, then they won't. However, if we see unexpected headwinds from ISM, from PMI continue to contract, then you're definitely going to see credit spreads widen. And we do think that they widen.
Yeah.
Whether or not they widen above that 600 or what we saw in the first week of July is yet to be seen. But we definitely think they're too tight right now.
I mean, the cash on the sidelines, it's a real, I wouldn't say it's a problem, but certainly there are people sitting on cash. It's like they're waiting. I don't even know what they're waiting for. Are they waiting for rates to come back down more? Are they looking to get in on certain opportunities that they feel aren't right for themselves right now? Clearly, we know that sitting on cash is not the right way to invest for the long term. But what's going on there? Is it outflows? Are they just, and then they're keeping it in cash, or it's just sitting there?
Well, I think the first 6 months with the cash on the sideline was just this large break in correlation between bonds and equity. They both went down.
Right, that's right.
So when
Which
they
is
both
unusual.
go down, you have this dash for cash,
Yeah,
right?
sure.
And a lot of this cash could be gone into, say, money market funds, right? Because bank deposits are still low. You have this dash for cash, so people are putting in money market funds just because that 60-40 methodology, which we all knew of, really wasn't working.
Right.
So I think right now, obviously, holding cash for a long period of time is not a right strategy. You should hold it for the cash needs that you have for a short term. But I think what's happening is people have this sort of fear of missing out. So the momentum, was starting with high yield credit or investment grade corporates tightening. People kind of rushed in, and that's what we saw. Now, whether or not that's sustainable is another question.
Right. FOMO is real, even in the financial markets, right? So, Leslie, as we wrap up, tell us what you're recommending to investors right now within the fixed income markets. What are the opportunities there? And we know that the volatility is likely to continue, and we're talking about the Fed. They have a lot of moves to make, and we may see them start to slow down the pace, but tightening is here. Given all of that, where are the opportunities today?
Well, when we look at sort of, let's say interest rates, for example, right? I mean, we wrote looking at the second half when we wrote in the Fixed Income Strategist, the majority of the headwind that we saw from that impacted total return was rising interest rates, right? You went from 1.5 to 3.5 within 6 months.
Yes.
Obviously, that velocity is not going to be the same thing. And we don't think that you'll even break the high that we saw at 3.5% 10-year yield. We think that you'll probably only go to around that 3.25. So it's not necessarily a bad thing to start adding sort of that interest rate risk around that 3.25. We do have sort of credit on in terms of the sense of things like preferred securities, which had really gotten hit early out of the gate. Even with those sectors, they have retracted alongside high yield and alongside investment grade quite a bit. So we wouldn't add here with those because they have tightened in tremendously over the past, since mid-June. They're up, I think, over 10%. So one of the things that we would do is that we would continue to diversify, but we like that up in quality a bit better. And we like the up in quality right now because finally, as fixed income investors, you can earn income. And there's really no reason to go to the lower credit quality right now. And even though, we might not be, late cycle, right? And even though the balance sheets and interest coverage and leverage are in good shape, we don't know how quickly this economy can unfold. And we don't know exactly what point that threshold is from the Fed that can really change the pendulum to where it starts hitting the labor market, it starts hitting the consumer, much greater than what we've seen so far.
Terrific. Leslie, thank you very much. Always good to have you here.
I
Good to see
appreciate
you.
it.
Get you back soon. A lot going on.
Thank
Lots
you.
to talk about, yeah. And thank you all for joining us. And for more information and access to all of the content coming out of our Chief Investment Office here at UBS, you can visit our website, ubs.com/views. Plus, take a look at social media. We've got content on all the major channels, Facebook, Instagram, Twitter, LinkedIn. You can check out also all of our past UBS Trending episodes on demand on our website and on the UBS YouTube channel. And as always, if you have any questions about your own portfolio, make sure to speak with a financial advisor. Until next time, I'm Anthony Pastore. We hope you have a great day, everyone, and remember to keep your eyes on what's trending. We'll see you soon.